Another day, another downgrade for Alphabet. Analysts fear that AI could be a growing threat to its dominance of the search engine market. Bernstein today downgrading Google's parent, saying increased competition is going to cap gains in the tech giant. It follows hot on the heels of a UBS downgrade on Monday. Equity research analyst Lloyd Walmsley there citing medium-term revenue risk and a better risk-reward skew in rivals Amazon and Meta. Lloyd's joining us now to talk us through his call. Lloyd, thanks for being here. So why, when you're looking at the sort of competitive landscape, or at least the competitive menu of where you want to put your money, do you think that Alphabet is not as attractive?
Yeah, it's a couple reasons. I think at the heart of it, the risk reward looks better to us at Meta and Amazon. So if we look at what's going on at Alphabet, they're integrating generative AI. There are likely to be benefits from that to them longer term, but there are also headwinds, right? The new SGE experience with generative AI, at least initially, appears to be pushing ads further down the page. So there may be some short-term revenue headwinds. Over time, they probably figure this out, but it's not totally clear. And then there's also some competitive concerns. We're less concerned about Bing and ChatGPT, though there's still slight risk there. But you also start to see Snap and ultimately Meta will move into chatbots, which have search-like behaviors and potential for search-like advertising. So there will potentially be some fragmentation on the query share and then some disruption on the monetization share. You look at something like Meta, on the other hand, and the stock, for starters, it's trading at 17 times earnings as opposed to significantly higher on Google. We think growth can be faster at Meta. And then the AI story there is not really well appreciated at all. And we think that they can generate as much as $7.5 billion in a bull case on the Facebook app alone from a generative AI chatbot experience. That's likely to hit Instagram and WhatsApp too. And this is much more incremental to Meta's business, whereas Google, what they're doing is kind of investing to stay in the same place. There may be some offensive side to it over time, but in the near term, there could also be some headwinds. There are just more questions. And with the stock hitting our old target and kind of not enough upside on our new target, we stepped to the sidelines on the stock overnight, the night before last.
Lloyd, I guess what I continue to take issue with, or at least scratch my head about a little bit, is how much these companies are going to be spending on their AI ambitions. Even if you think back to Meta's earnings call, they had said, we're going to give some more kind of guidance in the future about what that total dollar figure of expenditures towards AI will actually look like. Have we gotten any more clear indication from whether it's Meta or whether it's Alphabet how much these dollar figures could rack up to be in their spending versus how immediately accretive it will be to their business and profitable at the end of the day?
Yeah, you hit on a great question. It's the center of a lot of debates we have with investors. And we haven't gotten great specifics, but directionally, we have started to see signs that they are going to spend here. Google, for example, on their 4Q call, said that CapEx would be flat for the year. Well, 3 months later, they're saying it's up. And not only is it up, but there's going to be a big mix shift towards technical infrastructure and a reduction in CapEx on buildings and real estate. So the real CapEx on the server side is going up quite a bit. Last quarter, Meta said they didn't change their CapEx guidance, but they seem to open the door to spending more for generative AI. They said their existing plan does not incorporate a lot there, but I think in conversations since then, they've indicated that if they do see a lot of traction with product there, they might have to spend more. So coming out of last quarter, we took up our CapEx estimates for Meta from the low end of the range this year to the high end of the guidance range, and we took it up several billion above consensus for next year. So we do think they're going to spend there. And then again, with Amazon, we haven't gotten much in the way of specifics other than the company has been very clear that while they are reducing their CapEx on the physical infrastructure side for e-commerce, they continue to lean into investment in AWS, in part to get ahead of demand they expect to see from generative AI. So I think across the board, particularly as we get into 2024, we expect CapEx to continue to rise across the mega cap tech landscape.
Well, and I'm curious, Lloyd, is it increase or is it redeployment, both on the parts of these three companies, but also on the parts of their clients, right? Because, you know, big tech companies have AI budgets already, presumably, right? Is it just that they're redeploying that into generative AI, say, from the machine learning they were already doing, or what does that look like?
Yeah, it's a great question, and what we've found is that it depends on the company, but I think to a large extent they are able to invest less in CPU-based infrastructure. So some of it is just shifting from CPU to GPU-based infrastructure. Now, you know, GPU-based infrastructure is expensive, and I think there will be a net increase, but some of it will be moving things around. And then another thing we've heard talking to customers of the cloud platforms like AWS, GCP, Microsoft Azure, is that to some extent, the desire to do more generative AI will hasten their overall move of workloads into the cloud platform. So it may help the underlying business in terms of storage and compute as well. But bottom line is, it will, we think, drive a net increase, even if some of it's coming from existing CPU-based CapEx.
Lloyd, you mentioned something really interesting earlier, and I got to be quick here, but it is in how, where, and when some of the ads will appear when generative AI is really kind of engaged with from the user perspective, and any type of advertiser that's kind of putting creative out there and trying to make sure that their message gets in front of that consumer, how it is going to be much different than what we've known for the better part of 2 decades now. So all that considered, does it change the value of that ad placement so materially to the point where we're going to be looking at a different type of margin profile that the search engines are going to be able to generate?
Yeah, I don't think it's going to ultimately be all that different. Okay. I think our concern is that Google's optimized their search page for a combination of kind of user experience and monetization, and they've perfected this over, you know, a multi-decade period. And this is just a big change. They're prioritizing user experience initially, as they should, and so there may be some short-term disruption. We already see signs that it may look very similar over time with how the search page looked before, but we just think it's prudent to assume that there may be some near-term disruption while they effectively experiment with this.
All right, Lloyd, we appreciate the time here breaking down how you're looking at some of the biggest tech names across the street. Lloyd Walmsley, who is the UBS Equity Research Analyst. Thanks so much for the time.
Thank you for having me.